Hi guys, Michael Newrock here. Today's lesson is called Balanced Opportunity and Failure. Okay, I'm going to summarize a few points that we've already gone through, but these are critical. So if you hadn't really taken it in at the time, this is a great opportunity for you to do so now. Make sure you always have at least a 1-to-1 win-loss trade ratio or a 1-to-1 reward-to-risk ratio, preferably better. Preferably 2-to-1, 3-to-1, 5-to-1, 10-to-1. If you want to get into a trade and you're risking 20 pips, you want a reward of, say, 200 pips. That's a 10-to-1 ratio. You're risking 20, your reward is potentially 200. Naturally, as I always say, don't let your ego get in the way of a good trade. But at the end of the day, you want to have at least a 1-to-1 win-loss trade ratio or reward-to-risk ratio. So just to recap, if you're risking 20, you want to see at least 20 in the reward. If you're risking 30, you want to see at least 30 pips for your reward. If you're risking 50 pips, you want to see at least 50 pips in your reward. You don't want to go into a trade risking 40 or 50 pips only to get 10 or 20. It doesn't make sense. The only time that you should do that is during the trade. You're managing the trade. Perhaps the trade isn't going as well as you would have liked. Perhaps it went against you to start off with. These are the times when it's more than acceptable to get out early. And I've covered that in the previous lesson. But just to go over it again, don't let your ego get in the way of a trade. And there's nothing set in stone here. You don't have to hit that 1-to-1 reward to risk or win to loss ratio. But that is what you want to have at the very least when you enter a trade. Okay, there's a difference because we all go into a trade expecting good things. Otherwise, we wouldn't have gone into it. But we are going in there with confidence, with compelling reasons that the trade is going to go well. Okay, but we need to adapt to market conditions. And I've seen countless traders go extremely well to start off with and only hold out because they've been taught they've got to hit that 1-to-1 reward to risk ratio. They've got to do it. Why? Only to miss out by a few pips and for the trade to go, in the wrong way totally. And even worse, not to even break even, but to make a big loss. Now that's depressing. And when those kind of things happen, it can really affect and does affect, on average, a person's self-esteem, a person's confidence in themselves as a trader. And then you get a ripple effect to everything else in life and your personal life. Because, this is serious stuff here. We're playing for real, and trading is about generating wealth, not about losing wealth, right? So be aware of the risks existing in every trade. If you're not aware of the risks, then how can you take that trade? You need to be aware of the risk. Plan accordingly. Plan your exit strategy before the trade has even happened. Go through it in your mind. If the trade goes well, I'm going to do this, this, and this. If the trade goes bad, I'm going to do this, this, and this. Okay, have a plan. If you don't have a plan, you're planning to fail. On the other flip side, don't cut your profits short unnecessarily. You can tighten your stops, lock in those pips, lock in those profits. That's fine, especially if the trade isn't moving as fast as you would like it. If it's suddenly stopped moving in the direction that you were wanting and starts going sideways in a consolidation pattern. I mean, we don't win as traders when the trade goes sideways. No one wins, except for the broker. They're going to get their cut either way. But don't cut your profits short unnecessarily. It's always better to tighten your stops. And then if, the thing shoots up again, you're buying, obviously, and it's shooting up. Or if you're selling, it suddenly drops like a stone, then you're still in the game. And you'll be very glad that you didn't cut your profits short. Cut your losses short. Always do that whenever you need to with appropriate exit strategies. But when you're in the game, when you're in profit, stay in there for as long as possible. Or as I like to say, trail the trade FALAP, FALAP, for as long as possible. And we'll do a webinar on that shortly. Don't let your losses get out of control. And believe me, they can get out of control really, really quickly. There's a couple of ways that you can do that. We'll go into a bit more depth with this in a webinar. But let's say what some traders like to do is they'll cut their lot sizes down. So you lose once, cut your lot size down. You might lose again, cut your lot size down again. And when you start winning, you can start slowly increasing your lot size. Okay. Because personally, I believe that, well, trading is probabilities. Let's just say that. And things tend to happen in strings, and that is not just about the market. It's about what's going on in your personal life. When everything is rosy and everything is great in your personal life, you'll tend to do better as a trader. When things aren't going so well in your life for whatever reason, things tend to go badly, including trading. Okay. And that's the same pretty much for anything. So don't let your losses get out of control. It can happen easily. And, trading is a long-term journey. There's no rush. We don't want to put ourselves in a position. You don't want to put yourself in a position where things just get out of control. Set your risk per trade as a small percentage of your account. You can be a bit more flexible with this as you become more and more experienced because you know what to do, you know how to handle certain things, whether you win, whether you lose. So start with 1% or 2%, and then you can increase it to 3% or even 5%. But, this is really quite a complex issue here. So we'll go over it in more depth. And it depends on your exposure. What trades have you got open at that particular time? That's also going to affect things as well. Because if you've got 2 or 3 trades out already that are at 2% each, then you're 4 or 6% exposed. Unless, of course, you've locked in profits on those trades, then you can afford the opportunity to take out additional trades. But always keep your trades as a small percentage of your account. Safer is better. Use risk parameters as outlined in your business plan. Okay, so what you'll do is you'll know from what you've put down in your business plan what lot sizes you should be using for your account size, to make it proportional and, as a small percentage of your account. What pip sizes to use for your stop and how to adjust your risk based on, 1, your tolerance level, and also 2, the lot sizes that you're using. Limit the risk per trade to your comfort level. Once you're out of your comfort level, that's not a good thing because it puts more pressure on you to achieve a winning result. And when you're under more pressure, you're going down the rabbit hole. You're going in a direction that you shouldn't be going. So keep your risk per trade to your comfort level. Risk should be something that's manageable, not something that is going to be a disaster. And same thing with your winnings. On the flip side of that is that they need to be, big enough to be significant. Otherwise, they're fairly pointless, and then you let the trades run longer than they should, and then your winning trades end up being break-evens or losers, because you never locked in profits. So what's the point when, you're only $20 up? Big deal, let it ride. You get complacent, and you don't, trade as a trader. So coming back to risk, limit risk per trade to your comfort level. Limit your total risk exposure to your tolerance level. And I just went over this before. So if you have multiple trades open, then you need to ensure that it's within your tolerance level for that exposure. Because if it all goes bad and you suddenly lose 6 or 8% or 10 or more, then that's not a good thing. So we'll go over that in the webinar, and you'll have plenty of opportunities to ask me questions and go over examples, because this is the best way to learn from real life examples. It's one thing to know all of the theory and the concepts behind trading, but it's another to put it into practice and use real life examples, preferably in real time. That's what we're going to do. All right, guys, thank you for watching. Thank you for listening. I look forward to seeing you in the webinars, in the members area, on the forum, and helping you along your journey. Good trading, live well, and I'll see you soon.